Hello and welcome to Wescott's latest economic and market outlook. My name is Mark McCarron, and I'm the Chief Investment Officer here at Wescott. And the title of our presentation today is Bubbles, Balloons, and Budgets. There's a lot going on in the markets and the economy. And we thought this captured a lot of what's going on, and we'll get into the details of each one of those shortly. So thanks for joining us. And what we wanted to do today is just really bring everyone up to date as to what we're watching, what's going on out there, and how that impacts your portfolio and the way we think about managing your portfolio. So what's going on? I think the story continues to be inflation, and the good news is that U.S. core inflation continues to fall from its recent highs reached last year, and that has allowed the U.S. Federal Reserve to moderate their pace of interest rate hikes, which is great news. That's why the market has recovered, and we'll get into that. And that's been the biggest risk facing the markets really over the last year or so as we've moved from the pandemic era to the post-pandemic era. That spike in inflation really did cause a lot of volatility last year. But we're not out of the woods fully. There's still a lot of risks out there, and two geopolitical risks or tensions continue to be the conflict between Russia and Ukraine, which is still with us. And then the newest, this is where the balloons come in, the Chinese spy balloons over the United States and what that means from a relationship standpoint between the U.S. and China. The final issue that we're all facing here in the United States anyway is the debt ceiling debate that is likely only to intensify as we get closer to its official deadline, which is sometime in June. So bubbles refer to the market bubble that was popped last year because of high inflation. Balloons refer to the tensions that we're seeing, particularly between the U.S. and China, and the budget, which is perhaps the next big risk that we're facing. So let's go into it a little bit. Why did that bubble burst in terms of the market bubble? Well, you can look at this chart, and you can see that the effective funds rate went essentially from zero at the beginning of 2022 up to 4.5% of where it is today. And this, orange area up here, this sort of expected Fed funds rate for the next couple of meetings suggests that the Fed funds rate may actually get above 5%, closer to 5.25%. I think the shock to the system was early on in 2022, where the Fed had to move as quickly as they did. Today, these rate hikes, expected rate hikes, are effectively priced in to the markets, and that's why we've seen some recovery. I think investors do expect that the Fed will eventually reduce this Fed funds rate at some point, but inflation, whether you look at the recent CPI numbers or even the producer price index, which is another indication of inflation, still stubbornly high. So we're not out of the woods yet, and that probably could delay some of the timing. I think the markets, though, financial markets, are pricing in more hikes in the short term, but cuts in the future. And we can see that if we look at the bond yield curve, and the way that shows up is that the short-term bond yields are higher than the long-term bond yields. That's the market's way of saying things are tight and risky at the moment in terms of high rates and high inflation, but in the future, we expect these rates to be lower. And I think the market is long-term, and that's why the equity market and the bond market, we've seen some recovery. The other thing I would highlight, too, is that despite these rate hikes and expected continued rate hikes this year, a U.S. recession seems less likely, even though that was a fear at the beginning of the year. And that's because the labor market specifically, remains very resilient, and consumer spending continues to be robust. So despite high inflation, higher interest rates, which cause higher borrowing rates, consumers are spending and employers are hiring. So these are good signs for the economy and allows the Fed to continue at a modest pace. What has it done to the markets? I think we showed this chart a couple of months ago, but wanted to highlight this. This performance chart is really for select indices for the year-to-date period. It includes U.S. fixed income, which is up 1.4% this year. And if you look across all equity categories, whether it's large cap, small cap, non-U.S. markets, emerging markets, and China specifically, all are up in high single digit, even double digit territory so far this year. We're only halfway through the first quarter. And I think the U.S. fixed income markets returns are improving because of that interest rate outlook. Interestingly, growth stocks, which had the hardest time last year, are the leaders this year in the U.S. stock market, and they're leading the recovery. I think most interesting, perhaps, is the non-U.S. markets, including those in Europe, where Russia and Ukraine dynamic is more acute, and also in China, where we have that tensions, geopolitical tensions, that has not stopped the market from recovering pretty significantly this year, which allows a global balanced portfolio to perform well. Or again, a balanced portfolio is the way we think about building your portfolio, and a 5.5% start to the year is a very good one after such a difficult one last year. Already recovering quite a lot of what was lost, on paper anyway, last year. The next chart here is the same idea, but we just moved the time period back a little bit. We looked at the starting point for this was back September 30th, 2022. And that was pretty much the bottom of the market, or the trough of the market last year. And you can see the returns here have been very, very strong. Fixed income as a group up 3%. Non-U.S. markets, emerging markets up significantly, up 27% for non-U.S. There's a couple of reasons for that. Number one, improving economic fundamentals there, but also weakening of the U.S. dollar, which allows non-U.S. markets to recover. So there's a lot here. China specifically is leading the emerging markets, up 22.6%. Again, that's despite some of the rising geopolitical tensions that we see there. We're keeping our eye on that, but the market is moving in China mainly because last year restrictions for COVID were lifted almost entirely. And that was not the case for the prior 2 years. So I think there's a little catch up going on. And we wanted to ensure that our client portfolios had allocations to not only the US market, but the non-US market. And we do include China in that allocation. So a global balance index, which is again representative of the way we build portfolios, is up nearly 12% from its lows last year, which I think is a great sign and a good indication and consistent with our expectations as to what would have happened if rates sort of moderated a little bit and inflation came down, which is what we're seeing. So let's move on. We've got the bubbles in the market. We've got the balloons from China. Let's talk about the budget. So the debt ceiling debate will only heat up. We have a long-term chart here that shows the historical U.S. federal budget by fiscal year. So the blue bars show the revenues per year, or the blue section. The orange section shows the outlays, what the government is spending on. That includes Medicare, Medicaid, Social Security, defense and non-defense spending, and also net interest expense, or basically how much they're spending to pay for the debt. And just as a reminder, this is not new news, but the U.S. has run annual fiscal deficits for most of its history. There was a period back in the late 90s where revenues actually exceeded outlays, which is very rare. And but other than that, there's been a deficit, and there's been a lot of times historically, dozens of times, where the debt ceiling has been increased. Why is it different this time? Well, we've had two major fiscal responses to challenges to the economy. First, back in 2008, 2009, we saw the fiscal deficit increase dramatically those 2 years. And then the last example of that would be here on the chart, which is the COVID-19 fiscal response. So just to give you some indication, back in 2008, the government put $1.8 trillion into the economy to support it. This time, this most recent COVID-19 related response was double that, $3.6 trillion. And that's where you really see the federal debt increasing even more than it would have otherwise if we didn't have that pandemic. It just adds to the uncertainty and the risks out there. But just as a little bit of a reminder, the U.S. federal debt had more than doubled between 2007 and 2018. That was before the pandemic. And now, as a result of the pandemic, what we have is a basically the outstanding debt held by the public, which is federal debt, as a percent of GDP at 100%. You can see those same fiscal response pushing up the debt level as a percent of GDP back in 2007, 2008, and also again in 2020. Where do we stand on this? Our view is that the U.S. will avoid default just as it did in 2011, the last time we had this dynamic. But like 2011, we do expect some market volatility to get higher as we approach that final date in June, when the Treasury is no longer to use as extraordinary measures. But longer term, we can't ignore the fact that rising debt is a problem that the Congress can't ignore any further. And there's a couple ways to get out of it: either grow the economy faster or live with higher inflation. Those are the two short-term solutions, other than cutting programs like Medicare, Medicaid, Social Security, or raising taxes, which I don't see happening in the near term, and probably won't happen in this current political environment. So what do we do in the portfolios? Look, we're not positioning for a very specific outcome, but we maintain a short duration, short maturity stance in our bond portfolios that allows us to keep us less sensitive to what could be declining Treasury bonds and rising rates there. And on the equity portfolio, if we do have to live with some higher inflation, we expect our value tilted, income generating, inflation hedging strategies such as energy, financial services, industrials. These are all things that are in the portfolio already. Those are the emphasis that we have already. We think that should do well. And if we see what's going on in the non-US markets, particularly the emerging markets, that's why they play a particularly important role in the total allocation. So bubbles, balloons, and budgets are all the issues that we're facing. If we go forward as just a reminder of where we stand and what we're thinking of in terms of our outlook, we're happy to say that our balanced portfolios have recovered as the stock and bond markets rebounded from their September 2022 lows. We do anticipate inflation will continue to moderate, but this moderation may slow. So we might not get all the way back to where the Fed would like to be in the near term. We think China will continue to open its economy up as it did from a pandemic standpoint. This would benefit the global stock markets as well as the Chinese stock market because that should increase demand generally, but also should ease some of the supply chain bottlenecks further. And this is coming despite some of these rising geopolitical tensions with the U.S. So we're watching it carefully, but we're still looking at the broad reopening as the main theme in China. And finally, the debt ceiling debate likely to introduce some volatility in both the stock and the bond market. But we expect the U.S. to avoid default, but we're positioned, we think, appropriately in client portfolios to handle some of that increased potential volatility. So that's really our outlook. We wanted to give you a quick update on that since our most recent market commentary. We thank you very much for your interest, your confidence in us. Please do not hesitate to reach out to me or your advisor if you have any questions. Thank you very much.